All right, today we're tearing down a really detailed value investor analysis on a company that's been on a lot of people's radar, Laurentian Bank of Canada.
So, picture this. You're hunting for deals, and you stumble upon a Canadian bank. Usually a pretty safe bet, and its stock is trading for less than what its assets are supposedly worth. So the big question pops into your head. Is this a hidden gem? Did I just find the deal of the year?
Or is it a classic value trap? The kind of stock that looks cheap for some very, very good reasons. Well, that's exactly what we're here to figure out. So let's dive right into this analyst report and see what the story is behind the numbers.
So after sifting through all the financials and the business strategy, what's the final call? Let's just cut right to the chase. The recommendation from this analyst is a firm avoid.
Wow, this one quote really says it all, doesn't it? A structurally weak franchise. And here's the kicker. Even though it's trading below book value, the analysis argues it's still priced way above what the business is truly worth, its intrinsic value. Okay, so how in the world did they come to that conclusion? Let's unpack it.
So why such a strong avoid rating? Well, the analysis immediately flags three numbers that honestly paint a pretty troubling picture right from the get-go.
First up, 125%. What is that? That's the dividend payout ratio. This means for every single dollar the bank earns, it's paying out $1.25 to its shareholders. I mean, think about that. It's like your salary isn't enough to cover your rent, so you start paying it with a credit card. Sure, you can do that for a little while, but we all know where that road leads. It is just not sustainable.
And then there's this number, 2.84%. That is the bank's return on equity, or ROE. The easiest way to think about ROE is as the company's report card for how well it's using investors' money to make a profit. And a number this low, well, it's way, way below its cost of capital, which is usually around 10%. In simple terms, this means the bank is actually destroying shareholder value. Not good.
And finally, we've got 0.3%. That's the bank's revenue growth year over year. It's basically flat, zero. The business is completely stagnating. And in the hyper-competitive world of banking, if you're not moving forward, you are absolutely falling behind.
So when you put all these red flags together, the picture becomes really clear and frankly pretty risky. We've got a dividend that isn't backed by actual earnings, profitability so low it's wiping out value, absolutely no growth, and a business that is completely dependent on some future uncertain turnaround plan.
Now, these red flags aren't just a bad quarter or a temporary dip. The analyst makes it very clear that these are symptoms of a much deeper, more fundamental problem with the business itself.
See, at its heart, Laurentian is a smaller regional bank. Its focus is mostly in Quebec. So unlike the massive Big Five Canadian banks that are everywhere and do a bit of everything, Laurentian is a much smaller fish in a very big pond. And in Canadian banking, that lack of scale is a massive ongoing problem.
And this really lays out the disadvantage perfectly. The Big Five banks have huge economies of scale, meaning their costs are lower. They've got money coming in from all different places, brands that everyone recognizes and trusts, and they can borrow money more cheaply. Laurentian? Well, it's pretty much the exact opposite on every single one of those points. That puts them in a really tough spot, competitively speaking.
Okay, so given all these challenges, what does the analyst believe this bank is actually worth? This is where we get into the real meat and potatoes of the valuation.
And this right here is where that overvalued claim really hits you. The analyst crunched the numbers and calculated the bank's true intrinsic value at somewhere between 28 and 34 Canadian dollars. But when this report was written, the stock was trading on the market for around 40 bucks. That's a huge gap. It means investors were paying a pretty big premium for a business that is, fundamentally, struggling.
The analysis even breaks it down into different scenarios. In a bear case, if things stay weak or get worse, the value could plummet to $20. The base case, a modest recovery, puts it at $30. And only in a super optimistic bull case, where this turnaround plan is a massive success, does the value even get to $45. So if you were buying at 40, you were essentially betting that the absolute best case scenario was guaranteed to happen. That's a bold bet.
So, if the price at the time was a clear no, is there any price where this could actually be a smart investment? Well, the analysis tackles that question head-on.
Okay, so the analysts set a target. Let's say you want to make a 9% annual return on this investment, which is a pretty reasonable goal. The question then becomes, what price do you have to pay today to have a realistic shot at hitting that number over the next several years?
And here are the numbers. To hit that 9% return, you'd need to get in at $32 for a 5-year hold, and all the way down at $26 if you're planning to stick with it for 16 years. This just hammers home how far the market price was from what a disciplined, patient investor should probably be willing to pay.
Now, at first glance at this SWOT analysis, you might think, hey, the positives and negatives look pretty balanced. But, and this is so important, the analyst argues that the weaknesses, things like being a small regional player, are deep structural issues. They carry so much more weight. It's like a scale that looks even, but one side is holding lead and the other is holding feathers. The scores might look close, but the reality of the situation is much more fragile.
Okay, so let's wrap all of this up into a final, clear takeaway from this really impressive deep dive analysis. The analyst boils everything down to these 2 scores, and they tell you everything you need to know. A really high-risk score of 7.8 out of 10, and a pretty limited opportunity score of just 5.8. So the potential reward here just doesn't seem to justify taking on that much risk.
So, let's just quickly recap the main conclusions from the report. 1. The stock seems overvalued compared to what it's actually worth. 2. It's a high-risk investment because of its fundamental business problems. 3. That juicy dividend you see? It's more of a red flag than a benefit because it's totally unsustainable. And 4. This is not a stable, long-term investment. It's a speculative bet on a very difficult turnaround.
And the final piece of advice is crystal clear. The analyst says don't even think about buying this stock unless 2 things happen. The price has to drop below $28, and you need to see real, tangible proof that the business itself is actually starting to get better. Just a low price isn't enough. You need evidence of a real recovery. And there you have it. A really clear, data-driven case for why what looks like a bargain might actually be a classic value trap. It's a fantastic reminder that a cheap price doesn't always mean you're getting good value. So what company are you curious about? Let us know in the comments which deep dive you want to see us tackle next time. Thanks for watching.